This week's number, $218,000. That was the winning auction price for Steve Jobs' old Birkenstocks. The auction listing read, "The cork and jute footbed retains the imprint of Steve Jobs' feet, which has been shaped after years of use." Well, Jesus isn't that great. And when I say Jesus, I mean, let's be honest, these are Jesus sandals. In other news, tech icons don't live by the same rules as the rest of us. Welcome to Prop G Markets. Today, we're discussing earnings from Target and Walmart, hedge funds and their interest in Pinterest, and Estee Lauder's acquisition of Tom Ford. Here with the news is Prop G media analyst Ed Elson. Ed, how does it feel to be a Twitter celebrity? I noticed that before we started, you were complaining. You're a little bit of a diva. Did you get the calla lilies and the Haribo gummies that you wanted for your dressing room? Talk about the tweet that went around the world, Ed.
Yeah, it was very weird because I tweet stuff all the time and no one pays attention to it. And there was nothing different with this tweet. I was just complaining about crypto or whatever. And I woke up and I had like 40,000 likes. It was crazy.
And what was the tweet?
It was just, giving credit to the people who were skeptical about crypto and now they're sort of, it feels like maybe they were right. It was a pretty standard tweet.
Well, let's read it. Hold on. You wrote, the early crypto skeptics deserve more credit. Not only did they call all of this, they did so in the face of constant shaming and harassment, not to mention everyone pointing to the increasing value of their crypto wallets as evidence that they were wrong. What I found was interesting is a ton of people got very angry and weighed in and said, I've been saying, it's really interesting. People seem more interested in taking credit than actually illuminating people as to what the dangers are. Like a fight broke out on who deserved more or less credit around, warning on this.
It's so I tagged a few people who I thought were good, thoughtful, early skeptics, but I missed a bunch of people. And so all of the comments were like, you forgot me, which I actually think added to the virality because all these people were piling in wanting to take credit for it, which is fair, I guess. But yeah, the other thing that was interesting was it started the conversation was very civil to begin with, these very thoughtful responses. And then as soon as it sort of...
Not for long.
Not for long.
It's Twitter.
Pissing match.
Yeah. The other thing I found interesting is I couldn't believe how many likes you got. And so I thought, I want to check in on some of the biggest bulls. Mm-hmm. And so I went to Novogratz's Twitter feed, and he was saying that FTX had the magnitude of Madoff, the speed of Enron, and the fraud of Theranos. And I thought, shouldn't he be sitting this one out? Yeah. I thought, Jesus, you got to give the guy credit for what was his thing, Terra or Luna? Didn't he lose the value of basically Pinterest, Twitter, Dropbox in 24 hours? I thought, and then I went to, what is his name, Balaji, the really aggressive.
Yeah, Balaji.
I really enjoy his Twitter videos. He's super smart. He has an interesting view on trustless world, and he was talking about how this was evidence that the crypto market was cycling through true capitalism faster, and that it was the Fed that fucked up the economy because it bailed out the banks. I'm like, talk about turning chicken shit into chicken salad. He claims that this fraud and weirdness is really just capitalism 2.0.
Yeah.
I just can't get over some of these guys are somehow trying to position all of this as not as a bug but as a feature.
Totally. The new narrative is that it was all Gary Gensler's fault because he taught at MIT and the CEO of Alameda's dad also taught at MIT. So that's evidence that they were colluding and he's trying to protect them. And it's developing into this weird deep state thing, which I also just find ridiculous. And Balaji's said that too. He's been blaming the New York Times and Gary Gensler and all these sort of institutional people for protecting SBF.
Yeah, it's a deep state, not young people with no guardrails who move to the Bahamas and decide to start levering up 100 to 1. It's definitely the deep state, Ed. Anyways, Tell us about what's going on in the news.
Let's start with our weekly review of market vitals. The S&P 500 slumped through the week. The dollar lost some steam on signs that inflation may be easing. Bitcoin settled at above 16,000, a 2-year low as the crypto market roiled in the FTX drama. And the yield on 10-year treasuries fell in response to strong retail sales. That pushes the return on long-term treasury debt nearly 70 basis points below the shorter-term 2-year treasury. That's known as an inversion, since typically the longer-term note should provide higher returns than short-term debt. Inversions are a reliable forward indicator of a coming recession, and this is the largest inversion since the 1980s. Shifting to the headlines. UK inflation hit a new 41-year high of 11.1% as food, transportation, and energy prices soared. Amazon is the latest big tech company to announce layoffs. The retailer plans to cut around 10,000 employees. Meanwhile, Google is under pressure from one of its largest shareholders to cut back its workforce as well. And finally, the FTX collapse has caused a contagion in the wider crypto industry. Major firms including Genesis, Gemini, and BlockFi have suspended or delayed withdrawals from their lending units. Meanwhile, FTX founder Sam Bankman-Fried claims he is trying to raise new funding to pay back FTX's customers. But the company's new CEO, who also ran Enron during its bankruptcy in 2001, told the court, quote, "Never in my career have I seen such a complete failure of corporate controls and such a complete absence of trustworthy financial information as occurred here. From compromised systems integrity and faulty regulatory oversight abroad to the concentration of control in the hands of a very small group of inexperienced, unsophisticated, and potentially compromised individuals, this situation is unprecedented," end quote. Scott, so this story, it started as just another crypto meltdown, but it's starting to look like the meltdown of the entire industry. What do you think? Can the industry recover from this?
Yeah, I think it will. I just think it's going to be a lot smaller. It's already gone from a total market cap of $3 trillion, or the total value of coins, if you will. I think it went from $3 trillion, and I think it's about at 800 billion. So it's already recognized about, what is that, about a 75% drawdown in value. Mm-hmm. The thing that strikes me about this is that if you compare it to the subprime crisis or the mortgage crisis that kind of set off the great financial recession, nobody went to jail, or almost nobody, but it had an enormous impact on the economy. I think the NASDAQ was off 50 or 60%. I mean, it really was a pretty scary time. I remember a lot of the stocks I owned were off 80 or 90%. I remember Williams-Sonoma, I think, hit $4 a share. I was on the board of the New York Times. It went from 18 to $3 a share in like 5 months, or what felt like 5 minutes. I mean, the economy really, the Fed had to step in, emergency measures. There was a real worry that, get your guns in your butter and find your go bag and head to New Zealand. But anyways, this I think will be more spectacle than significant, and that is Amazon has shed $1 trillion in value in the last 12 months. So Amazon has lost the value of the entire crypto market. So, and when this was all unwinding, when FTX, which is the biggest sort of implosion to date, was unwinding last week, the NASDAQ had 2 of its best days in the last year. So the kind of the crypto spectacle, if you will, is like a gnat hitting the windshield of a much bigger economy. I don't think it's the end of crypto. I just think crypto will ultimately go where it should go, and that is the technology, and David Yermak said this on our pod, the technology will melt into a technology that companies should use that will make their companies more robust, whether it's through digital deeds or making remittance payments more fluid or whatever it is you use the blockchain for. I still have trouble figuring out what the actual utility on a day-to-day basis is with the blockchain. But it'll be absorbed into the broader business environment. But the speculation part of it, the casino part of it, will become smaller and smaller. And as you know, I'm on the board of a cold storage company called Ledger. That company has boomed the last couple of weeks because all of a sudden, even FTX, the administrator there, came out and said, get all of your shit out of here and put it into cold storage, because supposedly the day after, I guess, they filed bankruptcy, $500 million was transferred out and no one knows who did it, or basically stolen, or I mean, there is more to tell here, right? But I think again, it's going to make for a great Netflix drama. Yeah. I'm not diminishing the pain. I know a lot of young people who moved to Miami were very involved in crypto, and I think the majority of them, if they haven't been laid off, are about to be laid off. But you'll see the idea of this technology has moved digital assets forward. There's got to be some enduring technology that comes out of this, I would think. But the days of this being, having all the crypto Taliban tell everyone, including yours truly, that we just don't get it, that this is the future and it saves everything, and there is no industry that won't be impacted by that. I think that kind of big gulp ayahuasca, grande latte thinking has gone away. So it survives, but it's a shadow of itself, and it reinvents as more things like digital assets and identity and things like that. What are your thoughts, Ed?
Yeah, well, the thing that I was thinking about, you mentioned like a 75% drawdown. Meta had a 75% drawdown this year.
That's right.
Snap was down 80%. And I definitely can feel myself being drawn into the narrative of this. The narrative was exciting on the way up, and it's especially exciting on the way down right now. I've definitely become a little bit deluded by the story and by my own preconceptions about crypto, to the point where I'm blowing this up, and proportionate to tech companies, it's doing the same in a way.
But what you had here was there was a few dynamics that are different than other asset classes or stocks and bonds, and that is because it wasn't linked to any underlying intrinsic value or cash flows, it might as well be worth 1,000 or 100,000. So the carnival barkers promoting this thing would position it as the future, trustless, decentralization, economic freedom, all these wonderful things, and they weren't saddled by economics. Even Tesla has some gravity to it, because at the end of the day, people go, well, come on, it's a car company, and it's trading at 8 times sales, whereas BMW is trading at 1.5 times sales. It's fully, if not overvalued. Whereas Solana or Cumrocket, whether it was worth 1,000 or 100,000, you could say, well, it's going to 1 million. Why wouldn't it? If it got to 1,000, why wouldn't it go to 1 million? The same is true on the way down, and that is, I don't know, at some point, if Meta keeps going down, it's at a PE, I think, of like 7 or 8 now, meaning it's being valued like a low-growth old economy company. And the core business, as much as I hate Meta, is still a cash volcano. So they have, they do have a hammock, if you will, or they have a bottom. These companies, some of these crypto stuff, there isn't a bottom. Because if it can go from 1,000 to 100, well, yeah, it can go to $1.
Yeah.
So I think it could get a lot worse. A lot of people, and I want to go to sort of advice here, have said, should I invest? Is this an opportunity? Whenever the headline news is this bad, historically hasn't it been an opportunity? And I don't want to infantilize everybody and be an absolutist. Whenever you have an asset class like this that is not linked to any, as far as I can tell, intrinsic value, and you have this cocktail of carnival barkers using flowery language and using their Twitter followings to shame people who question it, what you have is potentially an asset class that could 10x. And I want to be clear. There's probably an opportunity to 10x here. In anything there's an opportunity to 10x, that means there's an opportunity to go to 0. And so don't invest more than you would be willing to lose all. It's like when I gamble. This is gambling. Let's be honest. This is speculative. This is gambling. When I gamble, I take $1,000 and I expect to lose it all. I hope I don't. I like the idea. I never 10x my money playing blackjack, but sometimes I can double or triple it. But anytime you can double or triple your money and get free cocktails in a couple hours, that means there's a good chance it's going to go to 0. So sure, if you want to get in, just take a fraction of your assets or investable income, because recognize, sure, you could double or triple here, but be clear, any asset class like that also means you could go to 0.
Yeah. Do you think that an asset class that, I mean, you just said that you don't think it has any underlying value. We should unpack that in a second as it relates to Bitcoin. Like a lot of Bitcoin maximalists would say, no, there's underlying value here, and that it's resistant to incompetent money supply and incompetent Federal Reserve decisions. But aside from that, do you think something that has no underlying value, is it ever possible that it could be actually enduring, or is it doomed at some point to go to 0?
So let's be clear. It wasn't fair to say there's no underlying value across any of these assets. And by the way, I think one of the most liked tweets I ever had, it was a year ago. I said, I am doubling down on the most innovative payment technology in history, USD.
And you got so much shit for that.
And I got so much shit. Okay, boomer. Every fiat currency, it just shows those who can't teach. But about 30 or 40,000 people kind of nodded their head and liked it. Mm-hmm. And what do you know? I think almost anyone in crypto in the last year would have rather been in this payment technology called the US dollar, which has soared.
Outperformed the S&P,
It's up 26% across a basket of currencies the last year. Anyways, Bitcoin's genius, and there is a genius here, is that this technology that forces you to throw a bunch of equations at a problem that takes massive computing power, thereby creating an increasingly difficult means of minting through energy consumption, has created scarcity credibility. And scarcity credibility is the fundamental attribute of a fiat currency, the belief that the central banks will have some discipline and just not go crazy Weimar Republic and just start printing more money, thereby diminishing or destroying the value of that store of value. So people believe, correctly or incorrectly, that Bitcoin is going to stop mining at 21 million coins. So as a store of value, it's actually, I would argue, held up. It's at whatever it is, 16,000, which obviously is about 75% down from the high. But where is that? It's probably where it was maybe 2-3 years ago. So it's not, I mean, Meta's where it was 5 or 6 years ago. So Bitcoin has held up better than Meta stock. Ether, it appears to me, so Bitcoin store of value, fiat currency, whatever you want to call it, and over the long term, every fiat currency does go away because at some point a politician comes in who's a populist and just starts printing money and the currency never recovers. But, that statement, over the long term, we're all dead. And then there's Ether, which appears to have some actual utility. And that is, my understanding is that's a technology that a lot of NFTs are minted on, meaning that the technology itself is producing assets that also have some value. Other than that, everything else is going into Chuck E. Cheese, turning fiat currency into tickets to play games, hoping you get more tickets to maybe get a stuffed animal, maybe get your fiat currency back. But there's so many games going on with that money you gave to Chuck E. Cheese where they go out and lever up 10-to-1 in all manner of speculative assets that by the time you get back to the counter at Chuck E. Cheese to turn your tickets back into fiat currency, there's a chance that everyone at Chuck E. Cheese got so freaked out when they found out what was going on with their money that they gave the counter that they all rushed the counter and said, give me my money back. And the front counter had invested in a bunch of car washes and things that were illiquid, and they can't get their money back soon enough. That's probably not the right analogy. But I do think you're going to see some enduring technology here. Is it worth $800 billion? Are the majority of these I don't know. Are the majority of these coins going to zero? I absolutely think so. NFTs, I was bullish on them because I think an emerging generation sees value in digital goods. My kids spend money to have skins on Fortnite or whatever it is, or have a better weapon. I think you're going to see the emergence or continued emergence. More people are going to spend more money on digital goods. I think people will spend a lot of money at some point to have their logo or their Twitter handle or their home in the metaverse have a Ferrari or a Chanel logo in front of that. I still think that market is going to emerge. But this market, I mean, it's like the market for Segways. They still produce Segways. Actually, I think they just discontinued them. It just never ended up being the market they'd hoped, right? It just never ended up being, I don't know what the right analogy is, a product that everyone thought was going to change the world and is still around, but it just hasn't lived up nearly to the hype. But you got to give the carnival barkers credit. They are not shamed at all. They're saying that this is just a dip. The analogy they use is that it's 2000 and that it was tulip mania. These things got overvalued, but these enduring giants of Amazon, Yahoo, eBay will emerge. I don't know. I was using those companies. I don't see how you use this stuff.
Okay, let's move on to our first story. Last week was a big week for retail. Federal data showed overall U.S. retail sales increased 1.3% in October, and that's the largest jump in 8 months, indicating that consumer demand is holding up despite inflation and recession fears. We also saw earnings from Walmart and Target, two similar businesses but with very different results. By all metrics, Walmart was a beat. Sales rose 9% to $153 billion, higher than Wall Street's estimates, and earnings per share came in at $1.50 versus $1.32 expected. Meanwhile, at Target, sales slowed and profits declined by 50%. Earnings were almost 30% lower than analysts' estimates. Target cited a few reasons for this. One, inflation. Walmart also mentioned that. Two, a general pullback from discretionary spending, that is, non-essential items like apparel and electronics. And three, interestingly, shoplifting. Target said theft incidents are up 50% year over year, and that this contributed to a $400 million loss in gross profit margin. Target shares fell 13% after that report, and Walmart shares rose 9%. So, Scott, it appears that overall retail's doing fine, but how do we rationalize the gulf between basically America's two biggest retailers here?
Well, a lot of it is just product mix, and that is the majority of Walmart sales, or about half, 46%, come from grocery versus about $1 in $5 come from grocery for Target at 19%. And in an inflationary environment where your purchasing power goes down, you cut out more discretionary items that Target sells more of, whether it's beach towels or toys or whatever, but food is something you usually don't cut down on. So what do you have? You had a revenue beat for Walmart and an earnings beat. Also, it's not a bad idea just to check in with your portfolio and look at its performance. And that is, I believe through the pandemic, Target was up substantially more than Walmart. And what you need to do is look at your gains and realize that gains never kind of, everything everywhere ends. And if a stock has had, this is a mature business. Big box retail is a mature business. They trade in a range of multiple on EBITDA. And Target had underperformed Walmart and then vastly overperformed it in terms of its stock price during the pandemic. Easy to say now, but Target was more vulnerable because it was trading. It had run up a lot. But this is a story about product mix. The other really interesting thing in this story is that kind of what you call organized theft. And it's the notion, and you see stories on this, where a bunch of people in a coordinated fashion sort of show up and just do a snatch and grab and overwhelm security, and there's nothing they can do. And I'm going to sound boomer on this. I think the algebra of deterrence has eroded, and that is there's been so many stories about how some cities are not even arresting people unless it involves a gun. I wonder if a lot of people have decided that they just don't have that much to lose, and a certain amount of lawlessness. And I hear myself saying this, and I just sound like, get off my lawn.
Right.
But there used to be the big thing when I was working with retailers was employee shrinkage, and that is the assistant manager closing up the store would just take stuff home with him or her. That was the big loss. That was what was hurting retailers, and now it's not even theft, but organized theft, which I find fascinating. And I wonder, again, if an erosion in the algebra of deterrence is having something to do with that.
Yeah. Well, the thing that's interesting is Target mentioned this. 50% year over year, that's a huge number. But Walmart said nothing about this. Home Depot also reported earnings. They said nothing about this theft issue. And then when we looked at the numbers...
How do you steal lumber, though? Home Depot...
I
would think Home Depot... How do you steal a washing machine?
Okay. Walmart, that seems significant that Walmart... they're attributing $400 million in losses from gross profit margin, and Walmart didn't even mention it. And if you look at the numbers from last year, retail theft overall in the U.S. increased only 4%. So it's up, but it doesn't seem like as dramatic as Target is presenting. Do you think it's possible that there's some sort of exaggeration here, or what do you think?
So you're highlighting a really important point in something that is endemic, consistent to all management, and that is if their earnings had been up, if sales had been really strong, 80% of the narrative would have been around the great decisions and strategies of me, the CEO.
Right.
And then when things go wrong, it's things outside of my control. And people have this same flaw, and that is when you're killing it, you're going to credit your grit and your character, and when things aren't going well for you, you're going to blame the market.
Yeah.
So never underestimate a CEO's ability to blame outside forces and creatively talk about reasons for his or her failure that are out of his or her control. And I think you bring up an interesting point. I don't doubt that this organized theft is an issue, but at the end of the day, as you pointed out, other retailers seem to be figuring it out. So I think that's a great point. CEOs are very creative around coming up with really good excuses for their failures.
Yeah. I mean, anecdotally, I walk into a CVS now and it feels like everything is behind a lockbox. Way
drives me
more than in the
fucking
past.
crazy.
Yeah.
I have to have someone come with a key to give me Advil.
Yeah. No, it's crazy.
Yeah, it's nuts.
Anyway, I just want to focus on Walmart for a second. Walmart said that they're seeing an influx in higher income customers. The CFO said that 75% of its market share gains in food came from households making more than $100,000 a year. Is that a function of inflation? Why are higher income customers becoming more attracted to Walmart?
I think you're seeing this is continued bifurcation, not only demographically, but psychographically. And we all know that the middle class has kind of gone flat for a while. People are escaping into the upper quintile. The middle class is typically identified as the three middle quintiles. The bottom quintile, lower income, the middle class, the three middle quintiles, upper income, the top quintile. And not only is the middle class shrinking or just barely holding, and some of that's good news. Some of the people are escaping into the top quintile. Some are unfortunately leaking to the bottom quintile. But we're also bifurcating psychographically. What do we mean by that? There are a lot of people who will pull into a Walmart in their Range Rover and buy their groceries at Range Rover and then swing by Chanel on the way home. And that is Walmart, Costco, Target, doing good to great. Chanel, Celine, Van Cleef & Arpels, Supreme, all killing it. The folks in the middle, the middle's kind of gone away. Who is the middle? The Gap? The Gap's gotten the shit kicked out of it. Sears and Kmart, gone. Anyone who tried to thread the needle between value and value add, anyone in between Walmart and Tiffany, has kind of been cleaned off the decks, and it's happened everywhere. There's Emirates, there's Qatar, and then there's Southwest and JetBlue, and the folks in the middle have gone bankrupt or survived because of a government handout. So we want to go somewhere that has everyday low pricing and has scale and uses technology to give me my case of ginger ale at the lowest possible price or near the lowest possible price, so I don't have to get coupons or do a search online. They have scale and technology and operational excellence. Or I want artisanship and signaling, and I'm willing to pay a lot for it. In China, this is on steroids. There's this whole class of young women who live with their parents, take the bus to work, make a good living, $70 to $100,000 a year, and buy $10,000 to $15,000 a year of handbags. So I think this is just a continuation of that.
Yeah. So would you have any advice for Target? It's interesting what you're saying. You just go really, really cheap, or you go high end, and you just got to pick a side. Do you think the answer for Target is you just bring prices down?
So I don't think they can out Walmart.
Yeah.
And I'm a big fan of role models. And that is, I think it's really almost everything in business has been done before or is being done. And so I'm a big fan. I don't think there's anything wrong with saying, okay, let's copy that. And in consulting, we call it benchmarking. And I made a nice living basically benchmarking every successful company in the world and then showing up to everyone from Walmart to Williams-Sonoma and saying, here are some very interesting things happening at different consumer brands around the world and things you might want to adopt. I think Target's role model should be JetBlue. So they're probably never going to be as valuable or as big as Southwest. Southwest kind of has a lock on the value market. Southwest does it better than anybody. Southwest buys orange paint. Why? Because they like that color? No, it's a hideous color. But because that color, for some reason, gets discarded and they can buy it on the cheap. They're almost all 737s because they realize the cost efficiency of scale around having one type of plane. JetBlue comes in and says, okay, we're going to be value, but value with a little bit of humanity and a little bit of sexy, right? Kate Spade uniforms, Blue Taro chips, leather seats. And maybe it's not $99, maybe it's $109. but it's got that same low cost credibility, but with a little bit of sex appeal. And that's what I think about Target. I love Walmart because I know the people there, and I think the management there, I think the CEO there, Doug McMillon, is just, I think he's a high character, outstanding leader. And almost everyone I've met at Walmart I've just really enjoyed. I think they're a good company. I think they're a decent employer. But personally, I shop at Target. I love Target. I think they figure out how to give me some of that jet blue sex appeal. I like the feel of the stores. I like the way they surprise and delight people. I think they've done an interesting job buying some sort of out-of-fashion aspirational brands and going vertical. So I think Target kind of keeps on doing what they're doing. I don't think I have any huge thoughts around what industries they should get into. They've both made huge investments in supply chain and technology and delivery and shop online, pick up in store. But I think Target I don't think there's anything wrong with Target that can't be fixed with what's right with Target.
Yeah. And just to close, there's been a lot of anxiety around retail this year about excess inventory. Walmart, Target, Gap, Kohl's, all of these companies are saying that they have this big backlog of products. It's piling up in the warehouses. It's affecting supply chain and inventory accounting and all these things. Based on Walmart and Target's earnings, that it seems like that problem's slowing down. Walmart's inventory growth went from 26% last quarter to 13%. Target's went from 36% to 14%. Is this whole inventory problem becoming a thing of the past, or do you think that's still going to be an issue for retailers?
Honest answer is I don't know. First off, I'm addicted to retail. I've somehow always been in it. One of my first clients was Williams-Sonoma. I started a retailer, Red Envelope. It's the shittiest business in the world. And that is, there's a million ways to die. Remember that song, A Million Ways to Die? In retail, it's human capital intensive. It's financially capital intensive because you got to buy stores. You can get screwed in real estate. Restoration Hardware was basically doomed for a decade trying to work their way out of 60 bad leases. When they went public, they took their capital and signed a bunch of irrational leases that they could never make money on. You got to get merchandising right. You have all sorts of, the economy can screw you. Operations can screw you. Planning. There's so many ways to screw up in retail. And the thing I don't understand, I keep hearing about supposedly Barry Ritholtz, who's I'm a huge fan of. I just think he's so insightful and interesting, also a really good guy. He put out this tweet saying that 40% of inflation can be reverse engineered to supply chain problems. And you would think at some point those go away. You would absolutely think that supply chain problems should be transitory. At some point, the lockdowns get eased up, the pandemic burns down in China, and we figure out workarounds. Maybe things are a little bit more expensive, but the supply chain kind of starts humming again and the wheels start turning. And that should take inflation in the U.S. down 3 or 4 full percentage points. So what I don't get is it because these retailers ordered up and they have too much inventory on hand? But even if they have too much inventory on hand, that should logically mean they need to cut their prices, which again should be deflationary. This is a long-winded way of saying, and this goes back to a prediction, I think, Ed, inflation in the U.S. is going to come down faster or as fast as it went up.
Okay, let's move on to our second story. A recent Bloomberg report showed that hedge funds have been buying up shares of social media company Pinterest in massive numbers. In the past quarter alone, hedge funds bought more than $1 billion worth of Pinterest shares. That increased their holdings by 73%, more than any other investment in the communications sector. This is coming after a relatively strong quarter for the company. Pinterest reported 8% revenue growth in October. And at the same time, hedge funds are unwinding their positions in Meta. Filings revealed that they sold more than $3 billion worth of Meta stock in the third quarter. Scott, Pinterest is generally a B-list social media company. I certainly don't use it. Are hedge funds seeing something here that maybe we aren't?
You're right. It's part of the tier 2. It's part of the bad news bears of social media. It's Twitter. It's Pinterest, it's Snap. Are there any other subscale ones? I think maybe it's those 3. What am I missing here? Reddit?
Truth Social.
Truth Social, there you go. Which, by the way, has shed about 40% of its value in the last week. Couldn't happen to a nicer guy. Anyway, so I think people say, okay, Twitter's off the market. Snap is controlled by Evan Spiegel. Might Pinterest be looking for an out? The CEO, Ben Silverman, just stepped down. He's the controlling shareholder, I still believe. So again, and I hate these dual-class shareholder companies, if you want to know what's going to happen in Pinterest, ask Ben Silverman's wife, because he gets to do whatever the fuck he wants. And it's dangerous because he's already rich. He's probably already a billionaire. And he might decide, Peloton would have been sold by now, but it's controlled by a small number of insiders. So, but it would make for, if you think about it, the fact that it only gets $1.56 average revenue per user, or ARPU, versus $3.11 at Snap and $9.40 at Facebook, probably is seen as opportunity right now across the people investing in this. And I think what they're likely saying is that it looks cheap relative to where it was. Its stock has been cut in half. Could it be a potential acquisition? Might Ben be willing to sell it to a bigger media company or a Microsoft, or name your favorite. Would Apple ever consider Pinterest? It seems to me if Apple wanted to ever be in social media and take advantage of their custody of the consumer with their phone and iOS, that the only social media platform that has kind of the aspirational, non-toxic feel would be Pinterest. So there's probably a number of acquirers that would consider it. I think it has about a $16 billion or $17 billion market cap, $2 billion in cash. So it's got about a $15 billion enterprise value. So Etsy, right now, Etsy has a $15 billion market cap. I think of Pinterest as being, at least it has a bigger footprint, but Etsy's probably a better business. But they're probably thinking that there's a floor. They probably look at the stock and say it's more likely to double or triple than it is to get cut in half.
I don't know if you remember last year, there were these rumors that PayPal would acquire Pinterest. And that was sort of floating around the news for a couple of weeks, and then PayPal ended up denying the rumors. But you said back then that you thought it was a good idea. And you talked a lot about how it's sort of like PayPal would be acquiring eyeballs for their financial product. Do you think it's possible that these hedge funds are thinking the same way?
Well, yeah. I mean, at the end of the day, they think that there's an acquisition, there's a floor on the stock price because of an acquisition premium. But here's the problem. There isn't a floor when it's controlled by one person, because that one person is immune from shareholder pressure. The reason why I thought PayPal might acquire Pinterest is that if you looked at the payments guys last year, so PayPal at its peak was trading at triple where it is now. It's got a $100 billion market cap now. It had a $300 billion market cap. So even when Pinterest was double where it was now, call it at 25 or 30, it would have been a 10% dilution for PayPal to acquire it. And what you had with these businesses was the payments business, they're good businesses. What you have with Pinterest is a lot of goodwill and user engagement. So how do we transition or transfer or translate that goodwill and engagement into a better business? Because the average revenue per user, the advertising business, is a shitty business. But if you could take all of those users and all of that affinity and the fact that they probably already maybe have their credit card, maybe already have their identity, have already signed up, are used to a user interface, and said, now you're good news, you're part of the PayPal network. And if you click on this soapstone counter, you can use PayPal to pay for it. And if you sign up for PayPal, you get $20 credit towards your next interest purchase on Pinterest. It's just the majority of acquisitions when PayPal was trading at $300 billion in market cap would have been accretive. What do we mean by that? They could pay a lot of money for acquisitions, and as long as those companies were somewhat profitable, it was accretive because PayPal was trading at such extraordinary valuation. In sum, you want to go shopping when your stock is overvalued because you can use your inflated currency to go buy business. And at $1/3 trillion, PayPal had a big freaking credit card to go buy stuff. Does it make sense now? Maybe not, because PayPal's market cap is now below $100 billion, and they probably have to pay $25 billion. So is Pinterest worth 20% of PayPal? That gets to the point where when it was 10% of the price, right, or 8%, that means it could have not worked out and it wouldn't be a career-ending injury. When you start talking about issuing a quarter of the company's shares to the holders of Pinterest, it best work out or management's going to get swept out. So now it's become more expensive. And while it still might make the same sense strategically, I think it's just become too expensive because the currency they would have to use has been cut by 2/3.
Mm-hmm. You were also mentioning this idea of a takeover premium earlier. Can you explain what that means?
Well, at some point, someone will swoop in. Peloton has value. Peloton's not going to zero. At some point, the controlling shareholders there would say, all right, we can sell it. Amazon would like to have a connected fitness company. Mm-hmm. Apple would like to have everyone from Beyonce and President Biden spending more time on iOS, so we're going to buy Peloton and put iOS on all the screens. Nike would like to be in connected fitness. They would like to move into fitness in the home. At some point with, I think they have, $125 billion market cap or some such, they would say, yeah, at some point if it gets down to, I think Peloton's at $5 or $6 billion now. If it went to $2 or $3 billion and the problems just got bigger and bigger, at some point someone would step in and the owners would say, sure, here you go, Amazon, here's the keys. Here you go, Nike, you take over. So there is a floor. There is a floor. Whereas a lot of companies, no one was going to buy FTX, right? The liabilities there were greater than the assets. There are real assets at a lot of these companies. Pinterest is not going to zero. There is a floor on the stock. People value the brand. There's a lot of engagement there. They do make money. So there is a floor, and someone would come in and acquire the company. Even if the business turned shitty and looked like it went unprofitable and looked like it was never going to get out of it, there's enterprise value there because it is worth something to someone else.
Yeah. But when you say takeover premium, that implies that you're paying more than the fair market value for the company because you're taking it over.
Well, not the fair market value, but the company trades. A company like Peloton, and I don't know, this might be losing money right now, and you think, okay, connected fitness, losing money, should trade at 1 times revenues. But here's the thing. At some point, big companies think that company's worth more than $3 or $4 billion to them just based on the attention they garner. Mm-hmm. So there's always a kind of a takeover premium built in, and that is the market goes, at some point this would get taken over, so the downside risk is somewhat limited, so the stock always trades a little above, not its fair market value, because that's part of fair market value, but trades a little bit above or sometimes substantially above where the metrics are.
Mm-hmm. And finally, something I learned reading this story is I didn't realize hedge funds have to publicly disclose their trades. It's specifically hedge funds that manage more than $100 million in assets. Do you think this is activity that investors should be paying attention to, or is this a distraction?
I think transparency is great. I think it's really interesting to see who's buying and who's selling. Mm-hmm. Especially what's more interesting is transparency across senior management. Because while you want to know what Berkshire Hathaway's buying, while you want to know what hedge funds are buying, be clear, these guys get it wrong all the time. As a matter of fact, a monkey throwing darts at a dartboard has outperformed the majority of hedge funds over the last several years because the majority of hedge funds, the way they are incentivized is they get 2 and 20. And investors don't want to pay a hedge fund 2% of assets and a 20% commission on profits to go buy Apple. They're like, I can buy Apple pretty easily on my own boss.
Right.
So what they want is sort of an esoteric, unique viewpoint, mostly bullshit, Web3, blah, blah rap that convinces you that they have these economic models where they can outperform the market. Mm-hmm. As a result, they have to go into more esoteric and weird stuff, which has underperformed the S&P. Mm-hmm. The SPY has been amazing up until the last kind of 7 months. Mm-hmm. So the alternative investment industry or the hedge fund industry over the last 10 years could best be described as expensive but bad. And that was you were better off just investing in index funds. So be clear, look at what they're buying, but don't kid yourself. They're not that much smarter than anyone else, and sometimes they're less smart. I always say look at them, learn from it. It's interesting to discuss, but at the end of the day, you want to be diversified, low-cost ETF and index funds. Take some money, invest in things that you have a passion about to learn about it, and who knows, there may be some asymmetric upside. And it's also, I think it's psychic income, but I wouldn't do that with more than, say, 30, 40, maybe 50% of your assets, 30, 40, maybe 50% of your assets as a young man or woman. But keep in mind, you also don't want to spend that much time doing this unless it's your jobs. But I love filings and disclosures, and here's why it's wonderful. Everyone has been writing about how certain VCs have lost their shirt because they've invested tens of billions of dollars in crypto companies. But here's the thing. They were not only investing in crypto companies, they were investing the rights to get a certain percentage of these coins once these quote-unquote projects or tokens were minted. And then what did they do, Ed? They dumped them. And so when a tier one venture capitalist says we're backing this company that's working on a project called the PND coin, which sounds for pump and dump. And we're this tier one VC that everyone thinks we're really smart. We invented the internet, or we're Sequoia Capital, we're Andreessen, whoever. Name your tier one VC fund. They get a bunch of coins, and they go, hey, everybody, retail doesn't know what the fuck this is, but there's a bunch of people on Twitter claiming it's the future, and this stupid shitty coin is trading at $1,000. Sell them all. And guess what? They didn't have to disclose they were selling them. So while we in the media are all saying all these VCs must have lost a ton of money on crypto, it's coming out now. No. Maybe the companies they invested in went to zero, but they made a shit ton of money because they weren't forced to disclose that the moment they got these coins, they dumped the bag on a retail public that, because they're following these very aggressive and very charismatic and very smart Twitter handles, that this was the future. And I think there's something wrong there.
Yeah.
I think that an institutional investor that invests in a company and owns over a certain amount of an asset should have to disclose their sales, because the asymmetry of information always benefits the person that has the information. And in this instance, the owners of the company or the investors in the company that got these coins looked at this and said, let's get the hell out of Dodge, and they dumped these coins on retail investors who woke up with coins that were sometimes down 90, 95, 99%. And guess what? Distinct of the company, how the company did, the VCs made out like bandits here.
Let's move on to our next story. Estee Lauder is acquiring luxury fashion house Tom Ford for roughly $2.8 billion. That's the largest acquisition in the cosmetic giant's 76-year history, and the deal is expected to close in the first half of 2023. Estee Lauder is primarily a beauty company. It sells brands such as Clinique and MAC, but this acquisition will allow it to enter new categories and compete with larger, more diversified luxury companies such as LVMH. Scott, you're an expert in luxury. What do you think? Is this a good idea by Estee Lauder?
Yeah, I think it is. Estee Lauder is a really well-run company, and it's got a great heritage. They have fantastic brands. They attract really bright people. Fabrizio, the CEO there, is a very talented manager. In addition, this is probably a decent time to be playing offense, and that is to make acquisitions. I think this company did. I think Tom Ford did about $1 billion in revenues, so they're paying 2.8 times revenues, which is not cheap, but it's not expensive. This gives them a big toehold or an increased toehold or footprint in the fragrance market. Tom Ford is one of those brands that is pretty iconic. It's you got to think there's a good chance Tom Ford, the brand, will be around for 20, 30, 50 years at least. So I think this makes a lot of sense. And it's kind of this will likely be a great acquisition, I think, because one, they're not overpaying. It's a great brand. They will benefit from the capital and distribution and scale around supply chain and manufacturing that Estee Lauder Company brings to the deal. So I think this will be a win-win. Tom Ford becomes a billionaire here. Estee Lauder has an $80 billion market cap, so if they pay $2.8 billion, they take about a 3 or 4% dilution. They have been a great acquirer. They acquired Mac. We talk about the greatest acquisition in tech was Instagram. They bought it for $1 billion, now worth probably 100 to 200, 100 billion maybe. 100 billion of that 250 billion is probably Instagram. By the way, a month later or a month earlier, Marissa Mayer executed the worst acquisition in tech. She bought Tumblr for $1.1 billion, and they sold it for, get this, $3 million about 5 years later. The best acquisition in beauty was probably a guy named John Dempsey, who was this creative icon in the beauty market, incredibly creative, strategic thinker. He was the driving force behind the acquisition of MAC Cosmetics, and I think they bought it for something like $30 or $50 million, and it ended up being $1 billion brand within just a few years. So, Smashbox, they bought a bunch of really nice brands, and then they take these things and La Mer, an amazing brand. They take these wonderful little artisanal brands that don't have the scale, the capital, or the distribution, and they blow them up. They blow them up. So I would be shocked if Tom Ford didn't see its sales go up double digits each year for the next 5 or 6 years. So I think this is Estee Lauder has been one of the best acquirers in the world of consumer. They say this is their attempt to get into more non-beauty products and become more of an LVMH, and I'm sure that's the story that they will tell the street. But even if it's just around kind of fragrance and beauty, in some Ed, I like this. Estee Lauder is a great acquirer. Tom Ford's a great brand, and 1 + 1 = 3 here. I like this one a lot.
How do you value a luxury brand, and for that matter, how you value any consumer brand? I mean, it's not like a SaaS business where you look at the sales and the users and the profitability. There are all these strange soft factors that you were describing, like with La Mer and with MAC. It's a great brand that has a lot of brand potential. From an M&A perspective, how do you put numbers on those metrics?
Well, at the end of the day, companies aren't sold, they're bought. And it comes down to what the seller and the buyer, if they have an overlap in terms of what they're willing to buy or sell. Ultimately, that's what dictates the price. Now, as a means of zeroing in or a starting point, traditionally every industry has general metrics. A company that is growing at 50% a year trades at a huge multiple on revenues, and it's usually not profitable. A more mature company trades at a multiple on EBITDA. Then there's industry averages, and they go up or down based on strategic fit, the brand equity. So this is a company that's got a strong. Tom Ford has a strong brand. It traded at, or they're buying it at what would be probably what feels like a rich multiple on EBITDA. But Estee Lauder probably says, okay, we can turn this billion-dollar company into $5 billion in 10 years, which means it'll be worth more to us than it is to them on their own. But it's pretty straightforward. It's what are we willing to pay for it? And a lot of people do stupid things. I remember, I think it was Unilever paid $1 billion for, was it Harry's? What was the shave thing?
Oh, yeah, Dollar Shave Club?
It was Dollar Shave. And I said this. I'm not playing Monday morning
Maybe
quarterback.
Harry's.
I said this right after they made the acquisition. I'm like, stupid. That company's not worth $50 million. But they were hoping that this direct-to-consumer model would infect the entire Unilever organization. No, it was just a cute little company that sold razors direct. It wasn't worth $50 million, much less $1 billion. So occasionally you can kind of be like this hot little thing. I talk to a lot of entrepreneurs. In my viewpoint, if you're a small company and you're hot for whatever reason and the market is hot, I always grab them by the lapels and say, sell. Because what you want to do, you want to sell the promise, not the performance. I remember the founders of Casper Mattress coming into my office, young guys, smart guys, and they were raising money at $1 billion valuation. And I think someone had offered to buy their company. I think it might have even been Target for $1 billion. And I'm like, don't be a fucking idiot, sell. Are you crazy? You're making mattresses and putting them in boxes. Do you think there's anything sustainable here? You think this is a tech company? You're selling mattresses. And I think now, I think they got a lifeline. I think they got taken private at 150 or 200 million after going public and starting to crash. But knowing when to sell is a real skill. And unfortunately, the optimism and consensual hallucination you enter into as a young entrepreneur makes you believe. And let me say this. I was offered $55 million for my first company, Profit, in 1998 by Sapient Nitro and Viant and Scient. We were doing $5 million in revenues. No, we were doing $3 million in revenues. Someone offered me $55 million. I'm like, no, we're going to the moon. And I was full of myself. And unfortunately, I hadn't developed a kitchen cabinet. And then 2000 came, wham, right? And then 2002, we were doing $12 million in revenues, maybe 10 or 12 million in revenues, and I ended up selling the company for 28. So instead of selling the company for 18 times revenues, I ended up selling it for about 2.5 times revenues. The market is always bigger than any individual. Market dynamics will always trump individual performance. So if you ever have the opportunity to sell, look around and say, is the market at highs or lows? If it's at highs, have a bias towards selling. And remember, the best time to sell a company is when the promise is amazing. And then I'll wrap up this word salad. Don't trust your instincts on this. Why? Because when things are jamming, when you're doing really well as an entrepreneur, you don't want to sell because things are going great. And guess what? that's exactly the right time to sell. Why? Because potential acquirers will smell those same good smells. They'll come in and they go, Jesus Christ, this thing's on fire. Mm-hmm. And then when things look tough, when things are hard, as an entrepreneur, you think, I'll sell now. Well, guess what? That's when it's hard to sell because acquirers are smart and they'll come in and they'll see the same issues. So when do you want to try and sell as an entrepreneur? When you're least inclined to and when the market is high.
Yeah.
Jesus Christ, let's just take a moment to talk about what a fucking Yoda I am right now. Oh, my God. Thank God I did the meth. I should absolutely do meth before every pod. I'm sorry, go ahead.
Okay, thanks, Scott. Let's take a look at the week ahead. We'll see the purchasing managers' indexes for U.S. manufacturing and services sectors in November. Those are typically indicators of economic strength or weakness. And the retail earnings roundup isn't done yet. We've got earnings from Best Buy, Burlington, Dick's Sporting Goods, and Nordstrom before the Thanksgiving holiday weekend. Scott, do you have any predictions?
Yeah, I made this prediction on Pivot this morning. So Amazon is off about 45%. Amazon is the first company in history to shed more than $1 trillion in market capitalization, which isn't a good feat, if you will. I think if Amazon goes down another 10 to 20%, or its stock goes down another 10 to 20%, you're going to see one of two things happen. They'll either spin AWS or Jeff Bezos will reclaim the helm as CEO.
Okay.
There you go.
That's all I got.
There you go. All right, Twitter God. All right, Twitter God. That's right. That's right. Trying to give credit to people, and then everyone tries to take the credit. I could not get over the shitstorm you caused, Ed. You're a celebrity, Ed.
That's right.
You're a celebrity. Well done.
Massive 200 followers from it.
Well
it's like
done.
A 0.02% hit rate or something like that.
Congratulations, Ed. Fame on Twitter means almost nothing. That's all for this episode. Our producers are Claire Miller and Jason Stavers. Special thanks to Catherine Dillon, Ed Elson, Mia Silverio, and the Prop G Media team. If you like what you heard, please follow, download, and subscribe. Thank you for listening to Prop G Markets. We will catch you next week.